Today we're going to examine buying a property through your self-managed super fund. We look at the funds available, the property analysis, the lending, the structure, some FAQs, and the growth over a period of 10 years. So to buy a property at 600,000, you need approximately 250,000 in your fund. When selecting a property, it's very important that you keep three things in mind. One is the maintenance over a period of 10 years. If you're buying an old property, there may be a lot of maintenance. Therefore, a brand new property is always beneficial. A steady capital growth is also beneficial, and a positive cash flow, I think, is imperative. So, therefore, we analyze any property that we suggest to you with these three criteria in mind. We're also going to look at all of the expenses and the income. When you look at income, you've got three types of income. You've got the actual rent coming in from your tenant. You've got your superannuation contributions every year that you contribute towards your super fund, which is coming out of your wage. And you've got your investment income. If there's some funds left over, you will then invest those funds, and those funds will also bear interest. Now, you've also got expenses, the expenses being your property manager, the water, landlord protection, council rates, body corp expenses, and your SMSF annual expenses. Now, these are all the expenses as compared to your income. Now, when we examine that in more detail, we find that you've got an operating income of 42,500 approximately. You've got total expenses of 7,946 approximately, and you've got an annual debt service, which is the loan that you have to repay to the lender of 31,000. That leaves you with a cash flow positive of 3,200. Now, that's a good property. So it's passed the test. Now we look at lending, and interestingly, a super fund cannot borrow money, and only under very, very limited circumstances can a super fund enter into any borrowing. So therefore, how are we going to fund this property? Because we only have 250,000 and we are buying a property at 600. The way is through something called limited recourse borrowing. So the fund superannuation rules allow a super fund to borrow money only under this limited recourse borrowing. What is limited recourse borrowing? It means if a loan defaults, the lender's rights are limited to the asset held in the separate trust. This means that there is no recourse to other assets held in the SMSF. Translate that into simplicity. It means that if you've got a balance of $250,000 in your fund and you've got a couple of other properties that you've purchased, if one of them defaults, the lender does not have recourse to go back and ask for any funds from the other assets. It can only return its loan from the asset that it has sold. So let's look at a little more detail into the funds required. Now we're taking into consideration all of the different costs involved in purchasing a property. You've got stamp duty, mortgage registration fees, the transfer fees, legal fees, lenders' upfront fees, and other fees, basically valuation. So the actual money that you require to purchase this $600,000 property was $634,119. Now, how does that work in terms of a structure? As I said, we need to have a limited recourse lender who's going to give you a limited recourse loan. We must make sure that the investment returns when the asset is sold can only go back to the SMSF trustee. And if the loan defaults, the lender's rights are limited, as I said. So, therefore, you need a bear trust. A bear trust or a custodian is the intermediary body between yourself and the actual lender and the property. So a bear trust is a document where the trustee holds property without any beneficial interest, which means that the document has the bear trust as the owner of the property, but not as the beneficiary of the property. It can't sell the property and take that money. The money must go back to the SMSF itself. So let's look at this graph, which may explain a little bit more in detail. The registered super fund, which is the RSF, has a custodian or a bear trust below it, as you can see the yellow box there. Now, this is the entity that will actually go out and buy the property, and this is the entity that enters into the lending. So the RSF appoints a bear trust. The bear trust then goes out and finds a property. The bear trust then gets involved with the lender to find the lending because, as I said, we only have 250,000, and you want to buy a property at 634,000, basically with cost. So the difference has to come from a lender. So therefore, the lender now provides 419,000, and the super fund provides 215,000. Now, with these two together, we can now purchase a property. 419 plus 215 is enough to purchase this property. Now we look at some FAQs. Can I access funds early? No, you can't. Not before the preservation age, which is your retirement age. Can I invest in a related business? You may have another business that you manage or you're a director of. Can you take funds from your super fund and put it into the other business? That's a no. Can I use my property as a holiday home? Oh, that would seem wonderful, but unfortunately, it's not possible. Can I pay myself as a director or a trustee? No, you can't. Can I lease my property to a related party? You can't. You cannot have your mother or father or your son and daughter and their family living in your investment property. Can I lend the funds to a member or their dependents? So in your super fund, you may have a balance of $200,000. Can you give a loan to one of your members or to their dependents? No, you can't. Can I buy artwork and hang it in my home? If you buy a Picasso, you cannot hang it in your home. So these are some of the FAQs that you may want. If there's any others, please do contact us and we can answer them for you. Now, how does growth work? Keep in mind before we go into that, please be aware that we are comparing a property investment versus superannuation. Now, these have a number of assumptions and market conditions and investment performance and tax regulations that affect it. Investment in property carries risk, including fluctuations in property value, changes in interest rates, and then for super fund, past performance is not a guarantee of any future results. Therefore, while the comparison provided may be useful, and in understanding the potential benefits and risk of these investment options, please don't use it without going through a financial planner for your particular circumstances. So here we are looking at the balance of $250,000 versus 250,000 invested in property. So on the left hand side, we've got your super balance of 5 at a 5% growth with a regular annual contribution of 15,750. No fees are considered, and we've got on the right hand side we've got 250,000 invested in a property of 600 at 5% growth with regular annual contributions of 15,750, no fees considered. So in the first one you see that the total return over 10 years is now your fund is worth $605,000, whereas on the other side your asset is worth now $1.175 million. How does it look in terms of gross after loan repayment? So you've got a property worth 1.175 mil. You've got a loan balance of 355. You pay off the loan. You've got a gross after loan repayment of 820,000. So it looks really good when you invest in property versus investing only in your super fund. So I hope that has been helpful to you guys. Thank you so much. Turnkey Home and Victorian Finance Group, we are interested in promoting financial health, and therefore we have partnered together with financial planners, accountants, and lenders to provide you with information and guidance to help you grow and prosper. Please, again, I remind you, if you do want to make any investment or set up a super fund, you must seek advice of a financial planner. Thank you.